Personal consumption growth in the first 6 months of this year was up over 4% annualized pace. It's just bizarre to be talking about a weak economy with one of the strongest 6-month consumption periods of the entire recovery overall. But there's enough weak data in manufacturing for sure.
And enough to warrant the cut yesterday?
Well, I think the goal of the cut to me was not really to stimulate growth so much as it was to take fear out of the market. And it didn't do that. I mean, it needed to take the curve inversion out. Didn't do that. It needed to at least steepen the yield curve, which hasn't happened. It needed to restore some confidence in the future of the recovery, which hasn't really occurred. And maybe worst of all, inflation expectations, rather than going up after the cut, have come down. So with the 10-year yield now below 2% this morning, it's just continuing to make the inversion worse, and it just keeps the market in the driver's seat, almost begging for another rate cut, unfortunately.
Yeah, Mike, the Dow's up 271 points right now. The read-through here seems to be that we got some softer than expected manufacturing data, so maybe perhaps that would incentivize the Fed to cut again. Is that why markets are higher today? And if so, is this a case of bad news becoming good news?
It seems like we're kind of on the verge of something like that, Morgan, or at least I think that there was a reassessment this morning that even though there was a lack of desired clarity from Jay Powell yesterday, the situation isn't that much different, right? The short rates are a quarter point lower. We have the same kind of deal where we have a 2% economy across the board, 2% growth, roughly 2% Treasury yields, almost 2% inflation. And guess what? What worked in that environment all year? Big growth stocks. So the market's grabbing for those growth stocks. It's sort of a back into growth and away from value. And in terms of the bond market, I agree with Jim. And if the bond market is effectively saying to the Fed, we can do this the easy way, we can do it the hard way. The easy way is you guys could have laid out a path to a few easing moves, or we can do it the hard way, which is we're going to keep the compression on this curve, we're going to take longer-term yields down, and implicitly you're going to follow us anyway. So I think it's an inherently ambiguous situation. Powell gave an ambiguous message because there are conflicting signals here.
Jim, interesting dynamic showed up in Qualcomm earnings last night, and that's this shadow of 5G, seeing a big slowdown in purchases of 4G and LTE equipment ahead of the 5G rollout. That's going to affect a lot more than just Qualcomm, and I wonder if people have been factoring that into the numbers overall, because these wireless networks are a global phenomenon.
I can't comment specifically on Qualcomm, but John, I think, though, that I still really like the tech space. You got an economy that's all recovery longs have been growing around 2.5%, and there's just so much growth, even if they're slower there, which is less cyclical and more sustainable, I think, until the next recession. And I think the leadership there that's been enforced probably continues until we do have another recession. Now, it might ebb and flow on reports like this, but I think overall, if there's weakness in that space, I'd be adding to it. Although I'd be adding more to the small cap S&P 600 tech names than I would to the 500 names.